When you decide to start a business in Denmark, one of the most fundamental choices you'll make is whether to operate as a sole proprietorship, or enkeltmannsvirksomhed, or to establish a private limited company, an ApS. This decision has implications for liability, taxation, credibility, and your long-term growth potential. So it's worth taking a structured, strategic view rather than simply choosing the fastest or cheapest option. Let's start with the core distinction. A sole proprietorship is legally inseparable from you as a person. You and the business are one and the same, which means that any profits belong directly to you, but so do all obligations and liabilities. In contrast, an ApS is a separate legal entity. It has its own balance sheet, its own obligations, and a clear legal boundary between your personal finances and those of the company. In practice, this legal separation is often the single most important factor. As a sole proprietor in Denmark, you are personally liable for all business debts and contractual commitments. If the business cannot meet its obligations, creditors can, in principle, pursue your personal assets, such as savings or property. With an ApS, your risk is typically limited to the capital you invest in the company, currently requiring a minimum share capital that can be contributed in cash or, in some cases, in kind. This limited liability does not protect you from every situation, for example, fraud or personal guarantees, but it does create a much more defined risk profile, which many entrepreneurs find reassuring, particularly in sectors with higher financial exposure or longer-term commitments. Beyond liability, tax treatment is another critical dimension. In a Danish sole proprietorship, profits are taxed as your personal income. This can be simple and efficient if your earnings are modest, and you may gain flexibility through schemes like the business taxation scheme, allowing some degree of income smoothing and deduction of business expenses. However, as profits grow, they push you into higher personal tax brackets, which can significantly increase the overall tax burden. An ApS, on the other hand, pays corporate tax on its profits. You then decide how much to distribute to yourself as salary and how much as dividends, each with its own tax implications. This two-layer structure adds complexity, but it also opens opportunities to optimize how and when you take money out of the business, to retain earnings for reinvestment, and to manage your overall tax position more strategically over time. Next, consider credibility and stakeholder perception. In Denmark, many customers, suppliers, and especially banks and investors view an ApS as more robust and professional than a sole proprietorship. The requirement to register with the Danish Business Authority, to file annual financial statements, and to maintain proper corporate governance sends a signal of structure and seriousness. This can be particularly valuable if you plan to work with larger corporate clients, apply for financing, or attract partners and co-founders. A sole proprietorship can certainly operate professionally, but it may not create the same first impression, and some counterparties will prefer or even require contracting with a limited company. That said, the simplicity of a sole proprietorship is a real advantage in the early stages. Registration is straightforward, administration is lighter, and accounting requirements are generally less demanding than for an ApS. If you are testing an idea, freelancing, or starting a side business with limited risk and low initial revenue, beginning as a sole proprietor can be an efficient way to enter the market without over-investing in structure. You avoid the upfront capital requirement of an ApS and keep your compliance obligations to a manageable level. Over time, if your business gains traction, you can reassess and convert to an ApS when the benefits of limited liability, tax planning flexibility, and enhanced credibility justify the added cost and complexity. Governance and ownership are also important considerations. As a sole proprietor, you cannot have shareholders. The business is tied to you personally. If you anticipate bringing in co-founders, investors, or offering equity-based incentives, an ApS provides the necessary framework. You can issue shares, define ownership percentages, and formalize shareholder agreements in a way that is simply not possible with a sole proprietorship. Furthermore, succession and exit planning are far easier with a company structure. Selling an ApS or transferring shares is typically more straightforward than transferring an entire personal business, especially when contracts, employees, and intellectual property are involved. When you think about practical day-to-day operations, there are trade-offs to weigh. Running an ApS in Denmark entails stricter bookkeeping requirements, potential audit obligations once you reach certain thresholds, and more formal decision-making processes, including board or shareholder meetings, even if simplified for smaller companies. You will likely engage an accountant to support you, adding to your fixed costs. By contrast, a sole proprietorship can often be managed with more streamlined accounting tools and fewer formalities, which can be attractive if you prefer to keep overhead low and your administrative workload light. However, you should not underestimate the value of good financial discipline, whichever structure you choose. Clear, timely financial information is essential for making informed decisions and demonstrating reliability to banks, partners, and authorities. So how should you decide between an ApS and a sole proprietorship in Denmark? A practical way to approach this is to ask yourself a few targeted questions. First, what is your risk profile? If your business involves significant financial commitments, long-term contracts, or potential liability claims, the protection of an ApS is often worth the additional cost. Second, what are your growth ambitions? If you see your business as a long-term, scalable venture, possibly involving co-founders, employees, or investors, starting with or transitioning to an ApS aligns better with that trajectory. Third, what level of profit do you expect, and how quickly? For modest, predictable income, a sole proprietorship can be efficient and straightforward. For higher profits, or where you intend to reinvest earnings and optimize your tax position over time, an ApS can be more attractive. Finally, how important are branding and stakeholder expectations in your sector? If your target clients or partners expect to work with limited companies, that expectation alone may push you toward an ApS earlier. In practice, many Danish entrepreneurs start as sole proprietors to validate their concept with minimal friction and then convert to an ApS once revenues, risks, or strategic needs justify the change. There is no single right answer that fits every situation, and the optimal choice depends on your specific business model, financial outlook, and risk tolerance. Before you decide, it is wise to consult with a Danish accountant or legal advisor who understands your industry and can model the implications under current Danish legislation and tax rules. By taking a deliberate, structured approach to this decision, you position your business not just to start, but to scale in a way that is robust, compliant, and aligned with your long-term ambitions in the Danish market.